stop for a moment. Before you listen any further, ask yourself one honest question. Have you ever actually seen money being created? Not earned, not saved, not transferred. Created, because if you haven't, that's not your fault. The system is designed so you never see it happening. You only see the consequences, the stress, the debt, the inflation, the feeling that no matter how hard you work, money keeps slipping away. And that feeling is not in your head. It's engineered. Most people believe money is scarce, that banks are careful guardians of wealth, that loans come from other people's savings. That belief is wrong, and once you understand why, everything starts to make sense. Walk with me through a simple scenario. You go to a bank. You apply for a loan. The banker looks at your income, your credit score, your documents. Then something strange happens. They approve the loan, but they don't go to a vault. They don't take money from someone else's account. They don't move physical cash. They open a computer. They type numbers. And suddenly, money exists. This is not exaggeration. This is not metaphor. This is literally how modern money is born. Here's the first truth most people never learn. Banks do not lend money they already have. They create new money when they lend. This system is called fractional reserve banking, and it is the foundation of the modern economy. The name sounds technical, but the reality is simple and dangerous. Imagine you deposit $1,000 into a bank. You think that money is sitting there, waiting for you. It's not. The bank is legally allowed to keep only a fraction of it as reserve. Maybe 10%, sometimes even less. That means out of your $1,000, the bank keeps 100. The remaining 900, it is free to lend. So the bank lends $900 to someone else. Now here's the key moment. That $900 did not disappear from your account. Your balance still shows 1,000. And now someone else also has 900. Two people. Two balances. One original deposit. Money just multiplied. But it doesn't stop there. The person who borrowed 900 spends it. The seller deposits that money into another bank. That second bank keeps 10% and lends the rest again. This process repeats again and again. From your original $1,000, the banking system can create close to $10,000. No factories, no extra work, no real production, just accounting entries. This is why people say banks create money out of thin air. Because functionally, they do. Now pause and think. If money can be created this easily, why are you told it's so hard to get? Why do you have to work decades to earn it? While banks create it in seconds. Because the system separates creators from earners. Banks create money. You chase it. And before you think this sounds illegal or immoral, understand this. This system is not hidden. It is written into law. It is taught in economics textbooks. Governments allow it. Central banks protect it. Because governments need it. Without this system, governments could not borrow endlessly. Wars could not be financed so easily. Massive spending promises would collapse. Debt is not a side effect. Debt is the fuel. Here's another uncomfortable truth. Almost all money in the modern economy is created as debt. When a bank gives a loan, it creates money and attaches interest to it. That means more money must be paid back than was ever created. So where does the extra money come from? It doesn't. It must be created through new loans. This means the system requires constant borrowing to survive. If borrowing slows down, the economy slows down. If borrowing stops, the system breaks. This is why recessions are so feared. Not because people stop working, but because people stop borrowing. Now think about interest for a second. Interest is the real business of banks. They earn interest on money that costs them almost nothing to create. If you borrow $300,000 for a house, you might pay back $600,000 over time. Half of that is interest. Decades of your life paid to a bank for numbers typed into existence. This is why banks love long-term loans, mortgages, student loans, credit cards. The longer you stay in debt, the longer money flows to them. And yet, people blame themselves. I didn't work hard enough. I didn't save enough. I made bad choices. But the game was rigged long before you started playing. You are told to respect money, fear debt, and trust banks, while banks quietly rewrite the rules. History shows what happens when this system goes too far. In 1929, banks expanded credit massively. People borrowed. Markets exploded. Then confidence cracked. The Great Depression followed. In 2008, the same pattern repeated. Cheap credit, housing bubble, complex financial products. When it collapsed, millions lost jobs and homes, and banks, they were rescued. Not with bank money, with public money. This is where the system reveals its true nature. Profits are private, losses are social. When banks win, they keep the gains. When they lose, society pays. This creates something called moral hazard. Banks are encouraged to take risks because they know they will not be allowed to fail. Too big to fail means too powerful to punish. And above the banks, there is another layer. A layer with even more control. Institutions that decide how much money exists, how expensive borrowing becomes, and how fast your savings lose value. Central banks. They don't wear suits and branches. They don't interact with customers. Yet their decisions shape your entire financial life. And once you understand their role, you'll see why inflation never truly goes away, why cash keeps losing value, and why the system always seems to need stimulus. Central banks don't need permission to change your life. They don't knock on your door. They don't announce themselves to ordinary people. They sit in quiet rooms, hold meetings, and decide numbers. Interest rates go up. Interest rates go down. And with those small changes, entire economies rise or fall. When central banks lower interest rates, borrowing becomes cheap. Loans feel easy. Credit feels harmless. People borrow more. Companies borrow more. Governments borrow more. Money floods the system. Everything starts going up in price. Stocks, real estate, assets. It looks like prosperity. But it's not real wealth. It's borrowed confidence. When central banks raise interest rates, the opposite happens. Loans become expensive. Debt becomes heavy. People stop borrowing. Businesses slow down. Markets panic. Suddenly, the same system that looks strong feels fragile. This cycle repeats again and again. Boom, bust, rescue, repeat. And every rescue requires more money creation. Central banks don't print money for people. They inject money into financial systems. They buy bonds. They support banks. They stabilize markets. This keeps the system alive. But it also creates a silent transfer of wealth. Those closest to the money source benefit first. Banks get liquidity. Institutions reposition. Investors buy assets early. By the time money reaches workers, prices have already adjusted. This is why inflation feels unfair. Because it is. Inflation is not just rising prices. It is the gradual loss of purchasing power. The same effort buys you less every year. You notice it in groceries, in rent, in education, in healthcare, but you rarely see it in your salary. This gap creates frustration. People work more hours, take side jobs, cut rest, yet still feel behind. Not because they are lazy, because the system is moving faster than them. This is why saving money feels pointless. You do everything right. You save. You avoid risks. And still, your money loses value, slowly, legally. Inflation punishes patience and rewards debt. Borrowers benefit. Savers suffer. And governments, buried in debt, need inflation to survive. It reduces the real value of what they owe. So inflation is tolerated, sometimes encouraged. Never truly defeated. This creates a strange world. A world where holding cash is risky. Where debt is normalized. Where asset ownership separates classes. Those who own assets benefit from money creation. Those who depend only on income fall behind. This gap grows quietly, year after year. Debt also changes behavior. People with heavy debt don't rebel. They comply. They can't afford to lose stability. They can't afford uncertainty. Monthly payments keep them running. This is not just economics, it is psychology. Debt shapes choices, limits freedom, narrows imagination. Education rarely explains this. Schools teach you how to earn money, not how money is created. You learn formulas, not structures. You are trained to compete for jobs, not question systems. Because a population that understands money is harder to manage. Ignorance keeps the machine smooth. Money itself is based on trust. You accept it because others accept it. The moment trust cracks, numbers on screens lose meaning. History has shown this many times. When money creation runs out of control, people rush to real things. Food, land, hard assets. Paper promises collapse. Systems reset. Yet the system always restarts, with new rules, new currencies, new promises. But the core remains the same. Control the money, control the system. Understanding this doesn't mean escaping completely. You still live inside the system. You still use its currency. But awareness changes how you move. You stop measuring success only in salary. You stop trusting numbers blindly. You stop believing the system is neutral. You see incentives. You see patterns. You realize money is not just a tool. It is power. Banks are not villains in a movie. They are machines responding to incentives. Central banks are not evil masterminds. They are guardians of a fragile structure. But fragility has a cost. And that cost is paid by ordinary people. Slowly. Silently. Every year. Once you see how money is created, you stop asking why life feels expensive. You stop wondering why crises repeat. You stop blaming yourself for falling behind. The system is not broken. It is functioning exactly as designed. And the most dangerous thing about it is that it looks normal. Now the question is not whether banks create money out of thin air. They do. The real question is whether you will continue treating money as something mysterious and untouchable, or start understanding the forces that shape your financial reality. Because in a world built on debt and numbers, awareness is the only real leverage.